Hello everyone. Today our topic is capital budgeting basics. As you all know at this point, the way that I like to begin each of these lectures is to simply locate us on the map for the semester. So where does capital budgeting fit into our narrative? Well, we remember that finance has been defined as the optimal allocation of scarce financial resources, which includes procurement, deployment, and distribution. We've broken deployment down into operational efficiency, asset purchases and sales, and go, no-go decisions. I told you the first day of the semester that we would spend most of our time focusing on the optimal deployment of capital, less time on procurement, less time on distribution. One of the nice things is, at this point in our journey together, we've covered quite a bit of ground. We've talked about operational efficiency. That was financial statement analysis and ratio analysis in chapters 2 and 3. We've talked about how to think about creating models that could give you some reading on whether or not assets are appropriately priced in the market. That was covered in chapter 7 for bonds and chapter 8 for stocks. So now where we are in chapter 9 as we think about capital budgeting is we're talking about go, no-go decisions. What we mean when we say go, no-go decisions are primarily whether or not to pull the trigger on a new product or introducing an existing product or new product into a new market. That's the primary question. A related question would be, among competing potential new products and or markets, which one should we invest in? So this is our primary concern today. We're thinking about creating a new product, offering a new service, or perhaps penetrating a new market, and we might be entertaining a number of possible new innovations along those dimensions, and we want to know whether or not we should do it. Should we introduce a new product and service? Should we penetrate that new market? Or if we're thinking about 4 or 5 possible new products and services and or new markets, which one makes the most sense? So we call that capital budgeting, by the way. In case I don't say that again, I want you to hear it. So how should we conceptualize this capital budgeting problem? Well, if we think about it, go, no-go decisions typically involve a very significant initial outlay up front, and there might be some significant outlays over the first few years, but let's call it just a massive initial outlay. And then after that, we hope that that initial investment will create positive cash flows for us thereafter. So the core of the matter is we can think of the initial outlay, whether it happens right away or over the first couple of years, we can sort of think of that as the cost of the project. And then we can think of the positive future cash flows that get generated from that initial outlay as the benefits or the utility. Most of you can probably see where we're headed with this. In essence, what we're asking is, does the value of the future cash flows exceed the cost? Well, that's starting to sound an awful lot like what we talked about when we did our asset purchases and sales conversations, specifically when we talked about models to estimate the value of bonds and stocks. What we were really doing in those valuation models is simply coming up with the present value of all of those future cash flows, taking into account time, taking into account risk, which we still need to talk about. But when we take into account time and we take into account risk and we calculate the present value of all those future cash flows, what we asked ourselves was, is the present value of those future cash flows greater than the price? That's exactly what we're doing here with go, no-go decisions. We're going to ask ourselves whether or not the present value of those expected future cash flows, whether or not that present value eclipses the initial outlay. So what I'm getting at here is we can think of go, no-go decisions as fundamentally valuation exercises. So we're going to call upon a lot of the same concepts that we've talked about in the 2 previous lectures about bond valuation and stock valuation to come up with models of how we can make decisions in capital budgeting settings. So the good news is we've already covered a lot of the difficult terrain when it comes to the intuition and the mathematical concepts. I think today's lecture is going to be fairly easy for you to digest, very intelligible, I hope, and also I hope very useful. So what are the specific capital budgeting tools that we're going to be addressing in this lecture? We're going to talk about net present value. We're going to talk about payback period. We're going to talk about discounted payback period. We will talk about internal rate of return, and we will also hit on modified internal rate of return. There are a couple of capital budgeting tools that are given some airtime in the chapter in the book that I'm not even going to wave my hands at. Those are the average accounting return and the profitability index. You can look at the book if you're interested to know more about that. I'm actually going to start with payback period, and then we'll move to discounted payback period, NPV, IRR, and then into modified IRR. So let's set the stage for how we're going to talk about these capital budgeting tools. I want to try to give us just a very small quasi-realistic case that will provide a framework for us, and then we'll sort of build on that framework to understand these capital budgeting tools. So here is the case study that I would like to use. Let me grow this a little bit so we can see it. So I'm considering buying a new vehicle to serve as my commuter car. The car would largely shuttle me around the valley during the work week. In other words, I'm not going to take it on trips. We have a different vehicle for the family that we take on trips. Right now, I drive a 2008 Ford Explorer. I get about 17 miles per gallon, and I drive about 14,000 miles per year. The annual insurance cost is about $650. I believe that I could sell my Ford Explorer today for about $9,500. So I'm considering purchasing a small all-electric vehicle from the Smart lineup of cars. I estimate the off-the-lot cost of purchasing the car would be about $24,000, so that includes everything: tax, title, tags. Purchasing an all-electric vehicle has the potential to earn me a $7,500 federal tax credit. Let's assume that that would be captured at the end of the first year. The car that I'm considering purchasing uses approximately 32 kilowatt hours for every 100 miles driven. We will assume that my cost per kilowatt hour is 12.4 cents. Let's assume I would drive my typical 14,000 miles in a year, and let's assume it is about a 20% cheaper to insure the electric vehicle than the Explorer. That would make the annual insurance cost about $520. I'm interested to know if selling my Explorer and buying this car is a positive NPV project. This is a very personal example of an interesting go, no-go decision. A couple of hints for us here. We're going to assume that the purchase of the electric vehicle and the sale of the Explorer would happen immediately at time zero. To make life easy, we're going to assume that the fuel and the insurance savings happen at the end of each year. Let's assume a 6.5% discount rate. We will challenge that assumption as we go through. We should check to see how sensitive our NPV and discounted payback period are to this, which we will. And I've created a shell for us, so let me show you the shell that I've created. You can see right here what we're going to capture, or what we're going to calculate, is payback period, discounted payback period, NPV, and IRR. So these are the tools, these are the quantitative methods that we're going to use to try to inform our decision. Now, we would never, and this is so important, we would never simply calculate a number and make a decision based on that. These are tools that go into your analytic tool belt to inform your decision, but there are going to be other variables that you consider. But you can see I've tried to create a framework for us here. So over here, I have the analysis inputs. I don't remember if I've said this yet, but in almost everything that I create in Excel, anything highlighted in yellow represents an input that the user has to populate manually. Cells highlighted in green are typically output cells in which there will be formulas. So you can see I've inputted our 6.5% annual APR discount rate. I could sell the Explorer today for $9,500. Right now it costs me $650 to insure it. I get about 17 miles per gallon. I drive 14,000 miles per year. I'm going to assume $2.50 per gallon is the cost of gas. That could be way off, but I'm going to use that. So I estimate that right now my annual fuel cost for driving my Ford Explorer is about $2,000. To purchase the electric vehicle would be $24,000. Again, that's off the lot. There would be a $7,500 tax credit, which we assume we could capture at the end of the first year. It would cost $520 a year to insure my vehicle. It's an electric vehicle, so it doesn't run on gas, but it's not costless. This vehicle boasts that it uses about 32 kilowatt hours to go 100 miles. I drive 14,000 miles per year, and right now my cost per kilowatt hour from Rocky Mountain Power is about 12.4 cents per kilowatt hour. So I estimate that my annual fuel cost would be $555.52. How am I getting that? Well, I'm just taking my 14,000 miles per year, dividing that by 100, multiplying that by the 32 kilowatt hours per 100 miles driven, and then multiplying that by the 12.4 cents per kilowatt hour. So let's talk about savings, annual savings. So I would be able to save annually about $1,500 in fuel costs, and I would be able to save about $130 annually in insurance savings. So my total annual savings would be about $1,633.30. So those are the inputs. Let's jump back in and learn a little bit about the intuition of these 4 tools, these capital budgeting tools that are going to help inform our decision. So first off is something called payback period. By definition, the payback period is simply the length of time that it takes to recover the initial investment. The general rule is that a lower payback period is better than a longer payback period. And we need to make a note here, if the payback period is not an integer, then we do have to do some interpolation. So let's go ahead and go back to our mini case about buying an electric vehicle, and let's apply the payback period and calculate how long it would take us to recoup our initial outlay. So let's go ahead and set up our spreadsheet. The cost to buy the electric vehicle is going to be this $24,000. That happens immediately. Remember, we said that the tax credit is going to come at the end of the first year, and that's going to be a positive cash flow, so it's right there. We said that the fuel savings would happen at the end of each year. So I'm going to go ahead and grab our annual fuel savings, which is right here. I'm going to do an absolute reference on that, and I'll simply slide that all the way down. Oh, I should also mention, I'm assuming, and look, anytime you do one of these case studies, there's always going to be a ton of assumptions. I know that makes us uncomfortable. I'm going to simply do the analysis for 10 years, and I'm going to assume that there's no salvage value at the end of 10 years. I'm also going to assume that the maintenance costs between the Explorer, hanging on to the Explorer, and buying the electric car, I'm going to assume that the maintenance cost would be a wash, that whether I kept the Explorer or I had the new smart vehicle, electric vehicle, that the maintenance cost would be the same. So those are just a couple of assumptions. Again, they might not be great assumptions, but I have to make some assumptions, and those are sort of simplifying assumptions so that I can at least demonstrate the principles. All right, we said that our insurance savings would be about $130 per year, so I'll grab that over here. Again, make it an absolute reference. Shoot that all the way down. Now, we did say that if I bought the smart car right now, the electric car, that I would sell my Ford Explorer and I could get $9,500 for doing that, and that would happen immediately. So now what we can do is we can calculate our cash flows every period by simply summing up all of these other columns. So, okay, what we've done right there is simply created a cash flow timeline, and what we want to do is calculate the payback period. So what I'm going to say is right now in period 0, the amount that we need to recoup is $14,500. That's the negative cash flow in period 0. Well, if we take that, we're going to recoup $9,133.30 of that in the first year. So how much would we have left to recoup after that first period? We would have $5,366.70 left to recoup. In the next period, we would start with $5,366.70 to recoup. How much of that would we get back? $1,633.30. So you're starting to see the trend. So I'm going to shoot this all the way down. And what I want you to see here is that our payback period is somewhere between the 4th and the 5th year. Can everybody see that between the 4th and the 5th year, we go from a negative amount to a positive amount, which means from the 4th to the 5th year, we fully recoup all that we outlaid in period 0. So our and remember, the simple definition of payback period is how long does it take me to recoup the initial outlay? Well, we know what happens in the 5th year, but we're going to have to interpolate a little bit. What we're going to say is we know that we don't need the entire 5th year, because going into the 5th year, we only need to recoup $466.79. We anticipate having net savings of $1,633.30, so we don't need the whole year. we can interpolate what portion of the year we need. If we make a really simple assumption, and here is the simplifying assumption, let's assume that all of these cash flows are received sort of evenly over the year. If that's how it breaks down, if the cash flows are received evenly over the year, then we can simply take this 466 that we have left to recoup at the end of the fourth year, and we can divide it by the amount of cash that we think we're going to get in the fifth year. And what that tells us is, that tells us the portion of the year that it will take to recover the $466.79. Okay, and we know that we need 4 years plus 0.29. So what would the payback period be? The payback period would be 4.29. So that's our payback period. Now, I'm going to show you a little Excel trick. I don't want you to freak out if you don't follow this. But I hope you can all understand that we don't want to just hard code in 4.29 over here, because what if we change some of our assumptions? What if we say, oh, the cost per kilowatt hour is actually going to be 13 cents? That's going to change our payback period. And so we want a formula over here so that if we change any of our inputs, payback period will automatically recalculate. So let me show you how you can do this. First off, notice we want the answer to be 4.29. Let me show you how you can quickly get to the number 4. The easiest way to get to the number 4 is to use what's called a vertical lookup function. And here's the way that the vertical lookup function works. The first thing it asks you is, what value do you want me to look up? Well, we want to know how long it takes us to fully recoup our initial investment. So in other words, in this column right here, the amount to recoup, we want to look for 0. We want to know where it hits 0. So we're going to look for the value 0 in this column. So that's the second thing, is you have to tell it where to look for that amount. So what we've told Excel so far is look for the value 0 in this array that we highlighted right here. Now it's going to ask for the column index number. For the column index number, we just want it to be the first column because there's only one column in this array. And then it's going to say, all right, do you want an approximate match or an exact match? We're going to have to do an approximate match. There won't be an exact match. I hope you can see 0 is nowhere to be found in that array. So I'm going to do an approximate match. Okay, can everybody see that what it's done is it's gone and found the closest number? So by doing the VLOOKUP, it's found $466.79. And Excel says, look, that's the closest I can find without going past your number. Okay, so once we have that, what we can do is we can use something called the match function. The match function will tell you where a specific number is in an array. So for instance, if I use the match function to look for negative 466.78, and I look for it in this array, what Excel will tell me is, it will say, oh, that's the 4th row. So we can use the match function with an embedded VLOOKUP to find the number 4, which is part of what we want. So what I can do is I can say, okay, match, and I want you to find that number. I want you to find it in this array, and by the way, notice I'm not highlighting period 0. And this time we want an exact match, so we're going to put 0. If I hit the enter button, that gives me a 4. So I'm going to do that much. That'll at least get us to the 4. So I'm going to say match, and what I want you to find, well, let's use our embedded VLOOKUP. You're going to look for 0 in the amount to recoup in the first column, and we're going to use an approximate match. But now, and that's the embedded, I hope you can see that's the embedded VLOOKUP. Now that I've closed the embedded VLOOKUP, now I'm back to the match function, and I have to tell it what array to look that up in. So all I've done so far is I've done match, and I've told it to look for $466.78, but now I have to tell it where to look for it. Now I'm going to highlight the array, but not including period 0, and I'm going to tell it to do an exact match. That right there at least gets me the number 4. Okay? Now there's a second part to this. Now I need to somehow get 0.29. But how did we get this 0.29? The way we got the 0.29 was by taking 466.79 and dividing it by 1,633.30. So we need to find a way to tell Excel to go get that 466.79 and the 166 or the 1633 and 30 cents. Well, getting the 466.79 is easy. How are we going to get the 466.79? We'll just do our VLOOKUP, right? So VLOOKUP, and we'll look for 0, and we'll look for it in the amount to recoup, and we'll look for it in that first column because there's only one column in that array, and we're going to do an approximate match. Okay, and then we would turn that negative. Okay, so we need to take this formula, and we're going to add that to what we've done over here. So what we have so far over here tells us how to get 4. Now I'm going to add on the beginning part of getting the minus 0.29. So I just added it in. Now don't freak out because we're not done, okay? The next thing we need to do is we need to get the 1,633.30. Let me tell you how we're going to get the 1,633.30. What we're going to say is this. When we look at this array right here, we know that 466.79 is the 4th row. What if we could come over to this array and simply grab the row right below that? So 466.79 is the 4th row in this array. We're then going to ask Excel to give us the number in the 5th row right here. The way we can do that is using the index function. Let me expose you to the index function. With the index function, if I highlight an array and I simply tell it the row number, it will give me the number that I want. So can everybody see I used index and I told it to give me the number in the 5th row of this array. How could we tell Excel to go to the 5th row? Well, what we could say is let's use the index function. We want to pull the 5th number from this array, but how are we going to tell it to get the 5th number? Well, ask yourselves, how did we get 4? The way that we got 4 is we did match, we did a VLOOKUP of 0 in this column, in the first column, with an approximate match. Then we looked up that number in this array, and we did an exact match. Okay, that gave us the number 4. But remember, we don't want 4, we want 5, so we're just going to add 1. Close it up, and does everybody see that that gave us 1633.30, which is what we want? So now I'm going to take that, and I'm going to come over here, and I'm going to add that to the very end. Okay, so let's walk through what I'm doing with this formula, and I'll zoom in so you can see it. So the first part, this match function right here, that's just getting the number 4 like I demonstrated to you right here. This part right here, this VLOOKUP, is simply getting 466.78, but we need to divide it by 1633. How did we get the 1633? We used index with an embedded match with an embedded VLOOKUP. So now if I hit the enter button, that's going to give me a payback period of 4.29. And the nice thing is if I change any of these inputs, so what if gas spikes to $3.50 a gallon, you can see that my payback period automatically updates and it's interpolated. I would never ask you on a test to be able to execute this formula that I showed you, but I just wanted to put it in front of you for those of you that do want to execute this in your jobs. What I want you to understand right now is, what does payback period mean? And what payback period means is, how long does it take me to recoup my initial investment? Given the assumptions that I put in front of you for our mini case, it would take me 4.29 years to recoup this initial negative cash flow of $14,500. Okay, the next capital budgeting tool that I want to expose you to is the discounted payback period. The discounted payback period is very similar in spirit to the payback period, with only one change. The discounted payback period does not use nominal cash flows to answer the question of how long it takes to recoup our investment. Instead, discounted payback period uses the present value of all of the future cash flows to answer the question of how long it takes us to recover our initial investment. What I'm getting at is this. There's an obvious problem with payback period. Payback period treats all of the cash flows as if they are equal. But we've been saying for quite some time now that there is a time value component to money. Specifically, the further out in time you go, the more we should discount those cash flows. But the payback period doesn't do that. It just treats them all as if they're equal. The discounted payback period takes a different approach and says, hold on a second. Why don't we calculate the present value of all of those cash flows and then use the present value of the cash flows to recoup our initial investment? So in order to do that, we would just use our cornerstone, keystone, seerstone formula, our fundamental time value of money formula, to calculate the present value of all these cash flows. Now, we know that the present value of this initial outflow is just going to be that nominal dollar amount. It's happening in period 0, so the present value of the negative 14.5 is negative 14.5. Starting, however, in this period, we need to take each cash flow and divide it by 1 plus our discount rate, which I'll lock in, and that needs to be raised to the number of periods out that we are. Okay, so all I'm doing is calculating the present value of all of those cash flows, and now we're going to do the same exercise. We're going to recoup this $14,500, but we're going to use present value dollars to do that. So okay, initially we have $14,500 to recover. In the first period, we would recover $8,575.87 in present value terms. That would leave us with $5,924 to recover. The next period, we would get $1,440 in present value terms. We just take this down the line, and everybody can see, not surprisingly, that the discounted payback period is going to be longer than the payback period. That ought to make sense, because those future cash flows that we use to determine our payback period are being reduced as we calculate their present values. Therefore, it's going to take longer. Okay, so we can see that our discounted payback period is going to be somewhere between the 5th and the 6th year. So let me walk through our logic on this one more time. We know that it's going to be somewhere between the 5th and the 6th year. How much of the 6th year are we going to need? Well, we're going to have $670.26 left to recover. In the next year, we anticipate $1,119 in present value terms. So what portion of that 5th year do we need? We need about 0.6 or 60% of that year. So the discounted payback period is going to be 5.59. Remind yourselves how we're going to get each of these elements. To get 5, we're going to use the match function with an embedded VLOOKUP. So we're going to do a VLOOKUP. We're looking for the value 0 in this column, right, the discounted payback period recovery column. There's only one column in that array, and in this case we're looking for an approximate match. Now so what that's going to do is that's going to return us $670.26. So then we're going to look up that in this array. Remember, now we're starting in the first period when we highlight that array, and now we're looking for an exact match. So that should give us 5. How are we going to get the 670? That's just going to be our VLOOKUP, and we're going to look up the value 0 in this column. There's only one column, and we're looking for an approximate match. So that's how we're going to get the 670, but we're going to turn that into a positive number. How are we going to get the 1,119 and 36? Remember, we're going to use the index function, and specifically we're going to look up right here in the PV column. We're going to look for that 1,119.36. How are we going to do that? Well, we want, in this case, the 6th row. How are we going to get the 6th row? We're going to do our match function with the embedded VLOOKUP, looking for 0 in this column. There's only one column. In this case, we want approximate match. Now we're looking for it again in the present value to recoup column, starting in period 1. We're looking for that number, which is 670.26. And now we want an exact match. Okay, that embedded match function, that right there, is exactly what we did to get 5. but we want 6, so we need to add 1 to that and close up the parent, and that gets us everything we want. So, okay, in order to get our discounted payback period, I'm just going to start with what we did here. Take that over and put it in there. I'm going to add to it this, which will get us the 670.26. So I'm going to add that in. And then we need to divide that last part by this formula right here. So I'm going to take that over here and put that in and divide by that at the very end. And that gets us 5.6. Okay, again, I hope you followed me. I want to reiterate, I would never ask you to execute that formula on a test. I'm more interested on a test in understanding whether or not you comprehend what discounted payback period is. But I did want to show you one more time how to make it so that your output equations are super dynamic, so that you can change any of your inputs and your outputs will change accordingly. After all, that is the power and beauty of spreadsheets. So, okay, what does payback period mean? Payback period means, given our assumptions, it would take me a little under 4.5 years to recoup my initial investment of $14,500. On a discounted basis, though, on a present value basis, it would actually take me 5.6 years. So that's payback period and discounted payback period. There are some pros and cons to each of those tools. I would like to repeat as well. These are tools that go in your tool belt. You would never make a decision based on one or even a set of numbers, but these are going to be helpful in informing you as you think about making this decision. So, okay, that's discounted payback period. Net present value is our next tool that we want to talk about. Net present value, by definition, is simply the total net value of the project in today's dollars. Let me just give you a little bit more intuition, then I'll show you the calculation, which I think is going to be very easy for you. So we know that the only utility offered by this particular project, at least the only utility that I can quantify, is future cash flows. Because of that, I can view this project as an asset. So I can value this go, no-go decision the way that I would think about valuing an asset. So how do we think about valuing assets? We've talked about this a lot at this point. The way that we value assets is map out the cash flows, find the present value of each of the cash flows, and sum all of the present present values. This is the mathematical representation of what I said right here. I hope you recognize this. This ought to feel very similar to how we priced a bond. The only difference is with NPV, we are now including the negative cash flow. We think of that as the price. So in a bond, we wanted to figure out the price, and the way that we figured out the price was to simply find the present value of all the future cash flows and add that up. Net present value is doing the same thing, except we're including the price. So what net present value tells you is it worth it? If you take the present value of all of those positive future cash flows and you net it against the price, is this a positive cash flow investment in present value terms? That's why we call it net present value. It literally tells you the net present value of this potential project considering all positive and negative cash flows. So there is a general rule when it comes to NPV. If the NPV is positive, then that means that this project will add value to the firm. If it's going to add value to the firm, then you should go ahead and initiate the project. In other words, go. If the project is negative NPV, that means that the cost, that initial outlay and all of the negative cash flows, that means that the cost exceeds the benefit. And at this point, it turns into something very basic. If the costs exceed the present value of the benefits, you should not do the project. This is a huge takeaway from this class. I realize that I throw a lot of material at you. Some of it is very technical in nature. Most of you won't ever be calculating net present values, but you will be sitting in rooms where they talk about NPV. And you need to understand at a minimum that the NPV rule is, if it's a positive NPV, we should think about doing this. If it's a negative NPV, we should likely think about not doing this. And you should also have some understanding that net present value is literally the net value of this project in today's dollars. Well, if there are competing mutually exclusive projects, then the answer would be select the project with the highest NPV if that's a positive NPV. The good news is we've essentially already calculated NPV, because in order to calculate the discounted payback period, we had to calculate the present value of all of the cash flows. So in order to get the NPV, literally all we're going to do is sum up all of these present values. And that's going to give us a net present value of $4,283.80. So it's that simple. Once you've calculated the present value of all the cash flows, you just add them up. Now there is an Npv function in Excel, but it's very important for you to understand that there's a long-standing glitch in Excel's Npv function. You cannot do Npv and then it says give me the rate. Well, there's the discount rate, and then it says, okay, well, what are your cash flows? You cannot just come over here and highlight the cash flows. You will get a different answer. Here's the reason. Excel assumes that the first cash flow you give it occurs at the end of year one. So if you come over here and highlight these cash flows, Excel assumes that this $14,500 is occurring at the end of year one, and this $9,133 is occurring at the end of year two. There's a simple fix. Just come in and do the Npv function, give it the rate, highlight the cash flows starting in year one, close it up, and then just add the year zero cash flow, because the present value of the year zero cash flow is exactly what you see on the screen. So that's the easy workaround, and you can see that that gives you the exact same answer as what we got doing it the long way. All right, so that is net present value. We now have 3 tools in our tool belt that can help inform us as we think about this project. I need to take a very quick digression regarding lexicon in order to help you understand the next tool that we're going to put in your tool belts, which is called internal rate of return. Here is the simple digression. When we calculate NPV, and again, here's the formula, it's a very basic formula, we have to take the present value of all of those future cash flows. In doing that, we use something called a discount rate. You remember why logically we call it a discount rate. It's because the further that cash flows get out in the future, the more we want to penalize them. We prefer cash flows now. So if there are cash flows off on the horizon, we've got to discount them, we've got to penalize them. And that's why we call it the discount rate, is we're reducing the value of those future cash flows, hence discount rate. But it turns out that it's not always called a discount rate. And so I want to talk to you about synonyms for the discount rate. And it sort of depends on what perspective you view this from. You can view it from the perspective of the investor, which is giving capital, or the corporation, which is receiving the financial capital. If I'm an investor giving the capital, I might think of that as a required return. Remember when we priced bonds, we said that what we used as the discount rate was the yield to maturity, because the yield to maturity captures all the risk, and that's something we need to worry about when we're discounting future cash flows. Side note, I don't know if you remember, but the first thing I said about all this was, okay, we know the basic intuition of valuing a financial asset, map out the cash flows, discount them back, but we said there was going to be 4 questions. What are the right cash flows to use? How do we forecast them? How do we take into account time? And how do we take into account uncertainty? And if you remember when we priced the bond, that's why we used yield to maturity as the discount rate, is because it captures the risk. So we found the present value of the interest and the principal payments by discounting them back using the yield to maturity as the discount rate. But you might also remember that we had another name for the yield to maturity. We called it the required rate of return. It was the return that investors demanded in exchange for giving their capital to a company in the form of a bond. So investors are going to call this thing a required return. Corporations are going to view it slightly differently. They're going to view it as the cost of obtaining capital. What they're going to say is, look, in order to float a bond, we're going to have to pay a certain interest rate, and to us that's a cost. So instead of calling it a required return, they're going to refer to it as cost of capital. We'll come back to that label later in the semester. But I just want you to see, okay, when we're doing time value of money, we call our discount rate. But it can also be thought of as a required return in the eyes of investors. It can also be thought of as the cost of capital in the eyes of corporations. Well, they all converge on another label. Both investors and corporations will often refer to it as the hurdle rate. And here's why they refer to it as the hurdle rate. Investors will say, okay, I have a required return and that's my hurdle rate. And if you can't beat that for me, I'm not going to give you my money. So that's why investors think it's okay to talk about it as a hurdle rate. The reason that corporations think it's okay to talk about it as a hurdle rate is that corporations will say, all right, we're thinking about investing in a new project. In order to do that, we're going to have to raise new capital. If our project cannot create a return that exceeds the cost to obtain the capital, then we're not going to do this project. So literally, that required return of investors, which is the cost of capital to the corporation, becomes the hurdle rate for projects, right? What we're saying is projects have to generate a return that beats that hurdle rate in order for it to make sense for a company. So I just want you to see that there's going to be a lot of synonyms for this idea of R. It will be called a required return. It will be called a cost of capital. It will often be called a hurdle rate. And in time value of money problems, it's called a discount rate. Okay, that digression is necessary in order to understand the idea of the internal rate of return, because what the internal rate of return is trying to do is it's trying to tell you what the return is to the project. Right? What we said is, if I'm a company, I'm not going to do a project if the return doesn't beat my hurdle rate. If the return doesn't beat the cost of capital, it doesn't make sense for me to do this project. So we need a measure of the return. So what is this measure of return for a project? It's called internal rate of return. So in a grand sense, you can simply think of the internal rate of return as the estimated annual return from doing this project. But I want you to understand the technical aspects of internal rate of return with a little bit more depth. So here's the technical definition of the internal rate of return. The internal rate of return is the discount rate that would make the NPV from a project equal to 0. I want you to think through this for a second. This is the formula for net present value. The internal rate of return is the R that would make the NPV 0. Now let's go back to our example. We calculated the NPV in this particular case. The NPV was $4,283.80, which means the NPV is positive. In almost all projects, the initial cash flow is 0, and most of the rest of the cash flows are positive. The internal rate of return is the R that would turn this positive NPV into 0. So I'm going to come over here to our spreadsheet and I'm going to entertain the idea that we might have different discount rates. So why don't we entertain the idea of discount rates starting at 5%, going up in increments of 2.5%. So that would take us out to 23%. So I want to see what would our net present value be depending on these various discount rates. I'm going to do a one-way data table. That means it's a one input variable data table. So I'm going to use this as my input variable, and I want to know what impact it will have on NPV. So I need to come to the hinge point of my table, which in this case is one row down and one column over from this first input variable, and I'm going to link that hinge point to my NPV. Then I just highlight the entire data table. I come up to Data, What If Analysis, Data Table, and can everybody see that I have a row input? I don't have a column input, but in this row I have an input, and that is my discount rate. If I click OK, it's going to tell me the NPV if I have these different discount rates. So let's turn that into a dollar figure, and what you can see is as the discount rate ratchets up, NPV goes down. And my NPV actually goes negative somewhere between 15 and 17.5%. So remember, the technical definition of the internal rate of return is what is the discount rate that would make the NPV 0. What I hope you can appreciate is that the net present value of this project as a function of the discount rate looks like this. Now originally we used a 6.5% discount rate, which is right there, and we got an NPV around 4,000. What you need to understand is that as discount rate increases, NPV reduces. So if the definition of internal rate of return is it's the discount rate that makes the NPV 0, then clearly in this particular case, the IRR is going to be higher than 6.5%. I hope that mathematically that makes sense to you as well. If you have a positive NPV using a certain discount rate, in order to get the NPV to 0, you've got to ratchet up the discount rate. So what that means is if the NPV is greater than 0, your IRR is going to exceed the discount rate that you use to calculate that NPV. Remember, we can call that discount rate the hurdle rate. So if you have a positive net present value using your original hurdle rate, then the IRR will have to be above that hurdle rate to turn the NPV 0. The opposite would hold if NPV was negative. So if NPV was negative, so imagine that you used a discount rate initially that puts your NPV somewhere down here. Then in order to get your NPV to 0, you would have to pull back on the discount rate, and in that case your IRR would be less than your hurdle rate. So now that I've talked your ear off about it, let's go ahead and calculate IRR. It's very simple in Excel. You just use the IRR formula and highlight all of your cash flows, but now you do start at period 0. So start at period 0, just highlight those cash flows, and it's going to spit out an IRR of 15.6%. If I put 15.6% in as my discount rate, it should give me an NPV of 0, and if I just expand the decimals on that, we could actually get there. So it's actually 15.603, and you can see it essentially gets us to 0. So that is internal rate of return. It's the discount rate that makes the net present value from a project equal to 0. That's the technical definition. Interpretation is that if your NPV is greater than 0, then your IRR should be above your hurdle rate. If your NPV is less than 0, your IRR will be less than your hurdle rate. But I want you to remember that just generally speaking, you can think of the IRR as the rate of return on your project. Then you take that rate of return and you compare it to your hurdle rate. If the IRR exceeds the hurdle rate, go. If the IRR is less than the hurdle rate, you should not do the project. Okay, what I'd like to do now at this point is I've essentially shown you the 4 tools that I wanted to put in your tool belt: payback period, discounted payback period, NPV, and IRR. Again, these are quantitative analytic tools that will inform your decision. What I want to do is just do a brief critique of each of the rules, tell you why we like them and why we don't, and then I need to show you some problems with IRR. So let's begin with the payback period. Remember, from our project here, the payback period is 4.29 years. That's how long it would take me to recoup my initial investment. So what do we like about the payback period? Well, first off, it's very easy to execute. I mean, I know I used an extended formula in Excel, but I hope you can all see that you could have calculated that on the back of an envelope in about 30 seconds. So it's easy to execute. It's intuitively very simple to understand. So when you're working with people who are part of the decision-making process who don't have a background in finance, this is a concept everyone can get their mind around. Look, it's going to take us 4.5 years to recoup our investment. Everybody gets that. Another thing that we like about it is biased towards liquidity. What we mean by that is, you remember how we said that there is a time value component to cash flows. So there's a time value to money. Further out we go with cash flows, the more we want to penalize those. Well, the payback period rule is biased towards liquidity. What I mean by that is the payback period completely ignores these cash flows off on the horizon. The only thing it considers is the cash flows necessary to get to that payback period. So it is biased towards liquidity. It does adjust for the risk of later cash flows, although it does so in a caveman sort of way. How does the payback period adjust for the riskiness of later cash flows? The answer is it simply ignores them, and that's how it's a caveman sort of risk adjustment process. What are the problems with the payback period? Well, there's no real technical consideration of the time value of money. Nothing is in present value terms. It's very unsophisticated. There is no clear rule. In other words, what should the rule be? If payback is less than 5 years, we do it. That would be arbitrary. So there's no clear rule. It can result in multiple payback periods. Imagine if there were actually negative cash flows in these years out here, then you could get multiple payback periods. And worst off, using payback period can result in accepting negative NPV projects. We know that we don't want to accept negative NPV projects, and yet payback period can cause that to happen. How about the discounted payback period? What do we like about it? Well, we like that it's still intuitively pleasing, right? It's still asking the question, how long does it take us to recoup our investment? We really like the fact that it incorporates time value of money, so now we are using present value. It does a much better job of adjusting for the riskiness of cash flows because it's actually using the math to get the present value. And you will never accept a negative NPV project using the discounted payback period. Because the minute that you have a negative NPV project, so let me show you, what if the discount rate was 20%, the NPV is negative, and you can see that there is no discounted payback period because you never recoup your initial investment in present value terms. So we like that about the discounted payback period. What do we not like? Well, it still requires an arbitrary cutoff. What is the right rule? Would you say that if the discounted payback period is less than 6 years, we should do the project? That feels very arbitrary. There's no science behind that. So we don't like the fact that there's no clear rule. It may reject positive NPV projects. So what if you set a cutoff at 6 years for discounted payback period, and you have a project with a 7-year discounted payback period, but the NPV is wildly positive? You can see that your discounted payback period rule might give you the wrong decision. And then lastly, if you have the discount rate, why don't you just calculate NPV? Why not just calculate the net total value of the project? Okay, that leads us to net present value, and I want to point your attention to my note at the bottom. NPV is considered the gold standard among the various capital budgeting tools. We have the most faith in NPV out of all of the tools I've put in front of you. What do we like about it? It accurately considers the time value of money. It accurately considers the riskiness of the cash flows. How does it consider the riskiness of the cash flows? We do that through the discount rate. So we started with a discount rate of 6.5%. If this was a risky project, you would move that discount rate up. So we like the fact that it's accurately considering the time component of money. We like the fact that it's accurately considering the riskiness of the cash flows. We love the fact that it gives us a clear articulation of the net value of this project in today's dollars. So that number, that NPV, literally tells us in today's dollars this project is worth $4,283. That's a nice, clean outcome. What do we not like about it? It's more challenging to explain. I mentioned earlier that you might be working with people who are part of the decision-making process who have no exposure to finance. Explaining payback period is very easy, the time it takes to recoup our investment. Explaining net present value is a little bit more challenging, and I would add, this is one way that you sort of create value for the company if you can use these more sophisticated tools and simply and parsimoniously explain to your coworkers what they represent. Some other cons: NPV is usually quite sensitive to the inputs, and it also assumes that all positive cash flows can be reinvested at the discount rate. Here's why that's a problem. What if this is a risky project, so you put the discount rate at 12.5%? It's still positive NPV, but that NPV number is assuming that all of these positive cash flows can be reinvested at 12.5%. Might not be a good assumption. In spite of all of that, we still believe that net present value is the best of the 4 tools I've put in front of you. Let's talk about IRR, the internal rate of return. What do we like about it? It's very closely related to NPV. Remember, if the NPV is positive, the IRR will be above the discount rate. And that's why the rule is very simple. If your IRR clears your hurdle rate, do the project, your rate of return is going to beat your cost of capital. We also like it because it usually leads to the same decision as NPV. We like that it focuses on value creation for investors. Are we beating the investor's hurdle rate? That's sort of the decision rule for IRR, but it does have some critical sort of fatal problems. The first one is that the IRR assumes that all positive cash flows can be reinvested at the IRR. Back in our problem, we found an IRR of 15.6%. That's incredibly high. To get that number, we're making the assumption that all of the future positive cash flows can be reinvested at that rate. That's likely not a good assumption. It may lead to the wrong decision when analyzing mutually exclusive projects. I need to demonstrate this to you, so I'll do that in a second. And then lastly, non-conventional cash flows may result in multiple confounding IRRs. I'm going to demonstrate both of these things to you here in just a second. In spite of these problems, which I'm going to demonstrate, IRR is still widely considered to be the best alternative to NPV. So again, these are analytic rules. These are quantitative metrics that are going to inform your decision. We would rank them sort of NPV number 1, IRR number 2, discounted payback period number 3, payback period number 4 if you put me against the wall and ask me to give you a hierarchy of which ones I think are more or less helpful. All right, real quickly, let me just show you these problems and how we fix them. IRR can lead to the wrong decision if you're doing mutually exclusive projects. Imagine you have two projects and these are the cash flows right here. So let me pull this up real quick. So again, imagine that these are your cash flows and let's use a 10% discount rate. When I calculate the NPV, I get an NPV of $29.79 for this project and I get an NPV of $29.06 for this project. I want you to notice these are the exact same initial investments. This gives us more value in today's dollars than this project. That means we should do this project. You want to do the project that gives you the highest value in today's dollars. Unfortunately, IRR suggests that you should do project A. So this is just me showing you one of the flaws with IRR is if you're comparing mutually exclusive projects, you should rely on NPV as opposed to IRR. Why is that? Again, it's because NPV is that true, clear, net measure of the value added to the firm, and we want to add the most value possible. So that's the first problem with IRR. The second problem with IRRs is if you get non-conventional cash flows, you can actually get multiple IRRs. To try to show this to you, let me give you again just a really quick mini case. Assume that you're the GM of the Utah Jazz. You're thinking about signing a free agent power forward. His agent has made clear the terms he is demanding. He wants a large upfront bonus and a guaranteed 8-year contract. I've mapped that out over here. So he wants $10 million upfront and $7.5 every year after that. You believe that while he is productive, he will substantially increase the team's income. He's going to fill seats. You might be able to raise ticket prices. He might get you deeper into the playoffs. You might get an advertising revenue burst out of this. However, you're concerned about his durability and you're worried he may only have 3 great years in him. So you estimate the following cash flows. You think you're going to get big bumps the first 3 years while he's productive, and then you're going to see the positive cash flows taper off after that. So here's the contract. Here are the cash flows. So these are the net cash flows if you just net the cost and the benefits together. So let's assume a 12% discount rate. I want to know what the NPV of this project is. Well, if you calculate the present value using a 12% discount rate, you get a negative NPV of $41,437. So should you go or no go with this project? And the answer is you should not do this project. However, the IRR looks like this. Let me back you up. You remember for our project, I showed you that this is what the NPV looks like as a function of the IRR. That's because we had conventional cash flows. What did I mean by conventional cash flows? If you look at our net cash flows, there's a single negative cash flow followed solely and exclusively by positive cash flows. But the example that I'm giving you now doesn't do that. The example I'm giving you now has a negative cash flow with a few years of positive followed by more negative. That unconventional cash flow chart is what leads to a very strange NPV profile. So if you calculate NPV as a function of the discount rate, it actually looks like this. Now there's the 12% discount rate giving us a negative IRR. But here's what's really scary about IRR. In this case study, if you calculate IRR, there are 2 of them. You can see NPV is 0 at 2 spots, and both of those IRRs are above your 12% discount rate. That's really alarming because remember the general rule. If the IRR is above the discount rate or above the hurdle rate, we do the project. In this case, you're getting a false go signal. Your IRRs are both above the discount rate, so you would do the project, and yet we know that it's a negative NPV project. So there are ways to fix this. The way that we solve the multiple IRR problem is by calculating modified IRR. So how do we calculate modified IRR? There are three approaches. I'm assuming that everybody's very comfortable with time value of money concepts at this point, so I'm going to move kind of quickly through this. Here's MIRR number one. It's called the discounting approach. All you do is you take all of the negative cash flows and you discount them back to time zero. So in other words, you take all of these negative cash flows, discount them back to time zero, and add them to that 10,000. So the cash flows in that case would now look like this. So all of the negative cash flows have been discounted back to time zero. We've left the positive cash flows the same. And then we go ahead and calculate the IRR. And if you do that in Excel, your IRR will be 11.848%. The second approach is called the reinvestment approach. The way that you do the reinvestment approach is to find the future value at the very end of all of the cash flows besides the initial investment. So let's think about how we would do that. If you look at all these cash flows, we would take this value, this positive cash flow to be received at the end of the first year, and we would move it forward in time. We would grow it in time using our discount rate. We would grow it in time until we found out the value of that at the end of the 8th year, and it turns out that that's 16,580. We would do the same thing for this cash flow received at the end of the second year. We would find its future value as of the end of the 8th year. Notice that we're doing this right because this negative cash flow at the end of the 8th year has that as its exact future value because it's happening at the very end. So we would take all these future values and we just push everything out. So look at the second column. Now we have a negative cash flow initially, and we've taken all of the other cash flows and pushed them out using our discount rate. So notice now it's a conventional cash flow structure. We have a big negative, and then we have only positives after that. If you calculate IRR, you get 11.942%. The third approach is just a combination approach. In the third approach, you would take all of the negative cash flows, find the present values, and slam them into the 10,000 like we did under the first approach. You would take the future value of all the positive cash flows and send them out to the 8th year. So there's 41,076. And then using this cash flow structure, you would calculate the IRR and you get 11.965%. The punchline to all of this is there's three ways you can calculate the modified internal rate of return. All of them are going to give you a slightly different IRR, but notice that all three of these modified internal rates of return are below the discount rate. So whereas your normal IRR is going to give you a head fake and give you the wrong outcome, it's going to give you a false go signal. If you use any one of these three MIRRs, it's going to avoid that false go signal from the normal IRR. I thought the last thing we would do is I would just show you what academic research shows are the most commonly used capital budgeting tools. This is a little bit dated, but my guess is that it still holds, and let's just focus on the bottom part of this chart. In 1999, some financial economists surveyed CFOs and asked them what they actually use for capital budgeting tools, and notice that the percentage of respondents who always or almost always use these tools, it ranks this way. Most CFOs always or almost always use IRR and NPV. You can see those are almost exactly the same. A fewer, but still over half use payback period, and then a big drop down to discounted payback period, and then those two that we didn't talk about. So my hierarchy was, I think NPV is the gold standard, IRR is next best, discounted payback period is third, and payback period is fourth. You can see in terms of how it actually gets used, IRR and NPV are neck and neck, payback period is in the middle, and then discounted payback period is far below that. Okay, so what have we done today in our lecture? What I've tried to do is impart 4 analytic measures, quantitative tools that you can use to inform your decision, but I said you would never make a decision based solely on these metrics. These would be things that would be informative but not decisive. These are pieces of information that would help you in the decision-making process. So let's just think about this for a second. The payback period is 4.29 years. How do I feel about the fact that it's going to take me 4.5 years to recoup my investment? Honestly, I anticipate holding onto this car for at least 7 years. I'm okay with a 4.5-year payback period. The discounted payback period is 5.6. Again, I'm planning to hold it for at least 7, so that's a number that's comfortable for me. The IRR is $4,283.80. Considering that my initial investment is $14,500, I really like that. My IRR is 15.6%. I don't think there's anywhere else I could put my money right now that's going to give me a 15% IRR. So all the numbers stack up really favorably. But I'm not sure I want to make this decision. There's a lot of other variables that factor in. This is a 2-seat vehicle. I wouldn't be able to shuttle my kids if I need to shuttle my kids. It would literally just be a car for me and one other passenger. I coach football. I couldn't even take my football gear in this car. So there are a lot of space constraints that concern me. I'm also very concerned about safety. I haven't looked at the safety ratings on this car, but I'm just 100% sure that if I get in a wreck in my Ford Explorer, I have a better chance of surviving than if I get in a wreck with a Smart for 2. Lastly, it's an all-electric vehicle. Right now, it only has a drive range of about 100 miles. That concerns me because I teach classes up in Salt Lake, and that round trip for me is slightly over 100 miles. I'm not sure I could even take this to teach classes up in Salt Lake. So even though the quantitative measures, the capital budgeting tools are telling me this is a fantastic financial decision, the other variables are probably outweighing the financial metrics for me, and I would probably conclude that I'm not ready to make this decision. All right, I hope you found these tools really helpful. I hope the conversation's been informative. When we get together, I'm going to launch you on a case study about whether or not I should put solar panels on my home. I'll see you in class.